JohnCBogle, Common Sense on Mutual Funds, New Imperatives for the Intelligent Investor. In Common Sense on Mutual Funds, JohnCBogle demystifies the intricate world of mutual funds, offering valuable advice to investors. The book emphasizes the importance of long-term investment principles and a disciplined approach to asset allocation. By analyzing risk tolerance and return, Bogle provides strategies for choosing the right mutual funds from a vast sea of options. This summary will offer ingenious insights for achieving your investment goals by understanding the significance of asset allocation, the drawbacks of market timing, and the benefits of index funds and bond as well as equity investment.
Revolutionary Common Sense for Investing. The book defines common sense as the endowment of natural intelligence possessed by rational beings and the plain wisdom inherited by every man. Thomas Paine's series Common Sense lit the fuse of the American Revolution, and common sense is not always abundant. To invest successfully, you must apply revolutionary common sense consistently to your investment strategy, selection, and performance. Investing is an act of faith, but your guiding principle should be appreciation for the long term. You must maintain a tolerable balance between risk and return, which is always individualistic. Asset allocation, the key to investment success. Asset allocation is critical when planning your investment portfolio since it largely determines its outcome. It entails selecting asset classes and the percentage of your portfolio invested in each. Achieving investment goals demands a disciplined approach and, most importantly, a focus on long-term goals. Index strategies offer the best choice for long-term investors looking to maximize their returns. However, many mutual fund investors are more enthusiastic about the process of investing, failing to understand the economics thereof. When selecting mutual funds, it's not advisable to look at past performance, as statistics show that the most successful funds do not maintain their edge for long. The mutual fund industry's betrayal. The mutual fund industry has abandoned its original principles of service and fiduciary responsibility. It has become a marketing-driven business that disguises poor performance and exploits investors through high fees. Fund managers prioritize their own interests instead of their investors. As a result, the industry resembles a closed cartel that desperately needs restructuring and transparent governance. Investors need to demand change and invest elsewhere if necessary. The two forces behind American markets. The stock and bond markets in America are driven by two historical forces: market fundamentals and speculation or trading based on opinions and emotions about the market. While investors trust their fund managers to generate positive returns, active managers often fail to outperform appropriate market indexes. It's been proven that stock managers have difficulty beating the market over the long term. Meanwhile, the most cost-effective approach to investing is to dispense with the active manager and simply buy a representative cross-section of the entire market. So-called passive investors never beat the market. But they never lag behind it either. This syllogism, the sum of active and passive gross returns equals the market's gross return. Active investors have higher costs than passive investors, therefore, passive investors earn higher net returns. 3 asset classes for investors. The importance of risk in investment strategy and the need for a diversified investment portfolio consisting of 3 asset classes: stocks, bonds, and cash. Investors looking to maximize returns while minimizing risk should focus on 3 primary asset classes: stocks, bonds, and cash. These classes serve different purposes, with stocks providing high returns, bonds generating income, and cash stabilizing principal and reducing risk. Risk is the most crucial element in any investment strategy, and investors must balance risk and return. High returns typically mean high risks, while low risks lead to low returns. However, investors can mitigate risk by diversifying their portfolios. By holding both stocks and bonds, investors can reduce their risk while simultaneously enhancing their overall portfolio returns, rather than exposing themselves to a bear market. Unfortunately, the industry has moved away from guiding principles, and investors must hold fund managers to a higher level of trusteeship responsibility. Allocating assets based on long-term goals and periodically rebalancing is crucial for success. It's important to note that this discussion of risk applies to the market as a whole, not individual stocks or bonds. With this in mind, investors can construct a well-diversified investment portfolio that balances risk and reward. Investing, keep costs low. Investing in mutual funds can be costly. While past performance records can be an indicator of risk and consistency of returns, the focus should be on minimizing costs. Compounding also applies to costs, so it's best to stick with no-load funds and limit the number of funds invested. Large funds can also be problematic as good performance becomes more elusive. Lastly, buying and holding, instead of flipping in and out of funds, is the best strategy to maintain low costs and maximize returns. The power of index funds. The book emphasizes the advantages of index funds and explains how they can be used to maximize returns while minimizing risks. Index funds are the bedrock of a solid investment portfolio. The author provides evidence that active managers rarely beat the market in the long run, and even when they do, it's impossible to identify them in advance. The index approach to international investing is also validated by the records of funds that invest in Europe. The S&P 500 fund was the first index fund and remains a viable option for investors today, even though it represents only 3/4 of the market's capitalization. For those who want to own the entire stock market, the Wilshire 5000 Equity Index is the way to go. Both indices generate comparable returns, making indexing a favorable choice. Indexing works in every market, even in relatively inefficient ones. It offers cost advantages that make it superior to active management in terms of returns and risk management. Index bond funds are also a smart choice for diversifying broadly and cutting down on risks without sacrificing returns. However, it's essential to keep costs low when investing in bond funds, since they often charge more than these advantages are worth. In conclusion, the book recommends staying committed to index funds for the long term to achieve both diversification and lower expenses. Global diversification myths. The idea that global diversification reduces portfolio volatility and increases risk-adjusted returns is flawed in practice. Currency risks may be responsible for apparent high returns in the short term, but these eventually even out. Additionally, American investors need not invest overseas, as the U.S. has the highest productivity, greatest innovation rate, most investor-friendly legal system, and most efficient market. Investing in the S&P 500 provides exposure to international growth, as 23% of their revenue sources are non-U.S. The benefits of global diversification may not be as significant as conventionally believed.
John C. Bogle's Common Sense on Mutual Funds provides investors with essential knowledge to decision-making in the complex arena of mutual funds. The book highlights the importance of long-term investment strategy and proper asset allocation. It also delves into the deceptive marketing techniques used by the mutual fund industry and educates readers on the limitations of relying solely on past performance. Bogle advocates for index funds, emphasizing their cost-effectiveness and ability to deliver consistent results. By following the key insights and clear principles, investors can make informed decisions, cultivate successful investment plans, and foster trust in the markets.